Good morning. Today is Thursday, November 3rd, 2022. We're going to talk a lot about the Fed meeting that we had yesterday toward the end of this presentation or toward the end of this call today. But we'll start on the economy. And I think we've had some earnings results this morning and last night that weren't all that great. Now, these are companies that are more discretionary and more tied to the economy. So you look at Qualcomm, they're down 8%. Pre-market. They now expect that the handset volume, the mobile phones for the year will be down in the low double-digit range. So think 10 to 12%. The prior guide was that the handset volume would be down in the mid-single digits, which is more 4 to 6%. So a big downgrade there. They said they have a lot of inventory that they need to clear in the channel. This is mostly on the Android side, but it is across all price points. So think your high-end Google Pixels, your Samsungs, all the way down to your most basic Android phone. So that's what happening to Qualcomm right now. That's going to be something to watch going forward. And they say that what happened was demand started to slow in June and July, but it really accelerated into September and October. And that's kind of the same thing that we saw at some of these other companies as well, is that things really began to deteriorate a little bit into September, October. Where it did not deteriorate was at booking.com. In fact, things actually improved in the month of October. You have room nights that are now up 12%. They were up 10% in September. You have average daily rental rates up in the high 20s. So they continue to enjoy a strong pricing environment. And they're not seeing any evidence of customers trading down to lower hotel star ratings or reducing the length of their trips. So you have some offsetting data there. On the housing side, Zillow reported earnings. They met expectations, but still down 72% year compared to the prior year. And they say that it just continues to get worse in September and October. And then finally on Peloton reported this morning, saw their revenue down 23% on a year-over-year basis. They expect that revenue will be down 37% next quarter. And the guy who runs the company now, the CEO, Barry McCarthy, he just doesn't get it. He starts with these motivational pep talks every time he reports earnings or lays off employees, and it just doesn't hold any water. I mean, the company's down, stock's down 17% today. Revenue guidance is going to be down, is 37% down in the December quarter. They're losing subscribers. And they say, and he starts off saying, quote, "If you ever had a goal you were serious about achieving, you most likely had a strategy for achieving it. And if you had a strategy, you also had a timeline. For the last 9 months, my goal has been to turn around Peloton and position it for sustained growth and scale. I thought it would take a year. We are beating that timeline." It's been 9 months and his revenue is getting worse. So the guy has zero credibility in my mind. For some reason, a lot of people like him. I don't get it though. He just lays off more employees and the company just deteriorates even faster.
I mean, they're going to go bankrupt before they can get bought, is what it seems like. I mean, I don't know what the exit strategy is for them, but the idea was that they were going to turn it around and get bought by somebody. And now, I mean, they might just straight up run out of money.
And you're a Peloton user or have used Peloton in the past, Tom. They're looking to launch a new Peloton app strategy next year. Do you think that's what they need?
I've never used the app. I mean, we do have the bike. I got it for my wife for Christmas last year. I don't use it nearly as much as she does. I usually run at lunchtime here. But I mean, the app is weird because I've looked at it because you can do like guided runs and guided stuff, but it just seems weird to me. Like I'd much rather just listen to music or a podcast than have somebody coaching me in my ear. Because I mean, what happens if you hit a stop sign, or like, you hit a stoplight, do you just pause it? Like I just something I haven't tried. I think Melissa, who works here, uses the guided runs quite a bit, but I mean, I just don't know what what that would look like unless it's just like telling you to do crunches in your basement. I'm not really sure what that would be.
Shifting gears a little bit to oil and gas. Gasoline supplies on the East Coast are now the lowest since November 2014. And this was primarily due to imports going to their lowest level since April 2020. So we're just not bringing in supplies from overseas, primarily on the ocean. Diesel supplies have moved up a little bit in the last couple of days as more imports came in from pipelines and ships, but nationwide inventories are still at the lowest seasonal level ever. And this is just as demand is picking up ahead of the winter. I'm not really sure what is driving this, if I'm being honest.
Unintended.
There simply just isn't enough ongoing oil supply in the system. And I do think that it may be related to refinery turnarounds as they produce heating oil. But, I think overall, the point is the system in oil and gas and products is extremely fragile. We haven't given more ability to build new refineries. We have, because of the regulations on them, the emission standards required on them. And for that reason, our capacity in refining is very limited. Our capacity in oil and gas production is limited. Our pipeline capacity is limited. So when you have all these limitations throughout the supply chain, whenever there's just a little bit of a crack, you're going to have that ripple effect go throughout. And I think that's why we're seeing these inventories at very low levels. And of course, that's only deteriorated further in recently as well. So that's something that we continue to watch. And I do think that oil itself probably remains upwardly mobile, given what's happening with the supply situation and the drawdowns of strategic petroleum reserve and everything we've already talked about.
I mean, it doesn't help that we've kept the price artificially low, right? It was going up for a reason. The reason was demand was high, supply was low. So what did we do? We started rolling out the SPR. We started cutting taxes across the board, and so what happens? People use more oil. Well, what's the result when all that rolls off? Suddenly there's not enough oil to go around because we've been artificially elevating demand and lowering the price.
Right. And the law of unintended consequences, we're seeing that in energy for sure. I mean, even the Bank of England actually came out this morning and they raised rates by 75 basis points, similar to what the US did yesterday. They're prepping for a 2-year recession, and they say that the energy price cap. So you remember they capped the price that people would have to spend on gas and electricity, natural gas and electricity, in order to make sure that no one freezes in the wintertime. Problem is, the Bank of England says, we get that, but that's only going to make inflation worse. And I have to say, the Bank of England was a little bit refreshing in their comments, because I think they actually talk about reality a bit better than most of the other central banks, which kind of try to paper over some of the issues that are currently plaguing the energy situation and inflation. But the Bank of England actually said, we're assuming that the current 6-month period of the energy price guarantee continues for the next 2 years. Such support would mechanically limit further increases in the energy component of CPI inflation significantly and reduces volatility. However, in boosting aggregate private demand relative to the August projections, the support could augment inflationary pressures in non-energy goods and services. And I think that's exactly right. They also go on to say that they think there's going to be a recession for 2 years, a 2-year-long recession in the UK. So I think that may be, hopefully that's a little bit calamitous, but I think at least they're talking about reality. And when you compare that to the ECB or even the Federal Reserve, I think there's just an uncomfortableness with which other central banks are willing to talk about recession, inflation, and the negative impacts of fiscal policy.
Yeah, I mean, it's basically like, you're getting called to the principal's office, you did something wrong, but instead of just fessing up, you're just like, oh, well, there were a lot of circumstances we couldn't control, yada, yada, yada. But the Bank of England, unfortunately for them, because I mean, that when you are honest with the market reacts to your honesty as well. And the Bank of England is in a tough spot. And we're digging in a little bit of this before the call on the structure of mortgages in the United Kingdom. Their housing market is about to get killed because most mortgages in the UK are either on a 2 or a 5-year fixed rate. And then at that point, you have the option of refinance, or you kick to one of 2 standard mortgage rates. And for context, last year, the average standard rate on a new mortgage was about 0.5%. And if you floated at the end, you'd be kind of somewhere in the 2% range. Well, after today, you're going to be floating somewhere in the 3 to 50% range. If you're in option one, if you're on the higher variable rate, you're looking at closer to 6.5%. So you could potentially have a mortgage where you were paying 0.5% mortgage and have that jump to 6.5% overnight. And if you're lucky and you can refinance, you're going to be paying somewhere in like the 3.5 range, which, is not better, because if you're you basically, your fixed cost of living goes up exponentially every single time the Bank of England makes a change. And so it's not great. I mean, there are going to be plenty of people who are suddenly unable to pay their mortgages because the magnitude of that change is going to be so severe and so swift that it's going to put them out of a house. So that's something to keep an eye on as well. The number of variable rate mortgages in the U.S. is exceptionally low. That was a mistake we learned from back in 2008, but it's definitely something to keep an eye on for England going forward.
Yeah, shifting gears to the US and what the Federal Reserve did yesterday. They raised interest rates by 75 basis points. So now the policy rate is between 3.75 and 4%. Now, that effectively means it's 4%. And they're probably going to tighten by another either 50 to 75 basis points next month. What they did say is that the terminal rate is probably going to be higher than what they thought before. So it's going to be higher than the 4.5 to 5% that they've been talking about for quite some time. And I think that plays a significant role in how we think about things going forward. Jay Powell, unlike the Bank of England, said that the path to a soft landing has narrowed even further, because before he was saying it was already a very narrow path. Now it's narrowed even further, but he still says that there is a path to a soft landing. And the way they're thinking about interest rates going forward, because we've had all this talk about pivots, they're thinking about three primary categories. The number one category is how fast do they raise rates? And there's some thinking that this may be slowing down. They're definitely going to discuss 50 basis points next month rather than 75 basis points. Jay Powell said exactly that at the press conference yesterday. So how fast is question one. Second question is how high is the ultimate level of rates? And this is where Jay Powell was most aggressive yesterday, basically saying we're not anywhere close to talking about a pause in interest rate increases. And
that was pretty much his exact quote was, I don't know where you guys are getting this pause talk. It's like, no one's ever said that.
They may go slower, but they're going to keep going. Yeah. And the way I liken this is to almost Chinese water torture versus just ripping off fingernails. Rather than creating pain at once, trying to just crush inflation with that one action, you're trying to build this pain into the system. And then the Federal Reserve is going to look at what they've previously done, the so-called lagged effects, as well as where inflation is and where they think it's going to go in order to make policy going forward. And they're just going to keep dripping this until they think that policy is sufficiently restrictive to bring inflation back down to 2%. And right now, the market now thinks that's about 5.25 to 5.5%, which is a little bit higher than when we were talking yesterday. But I still think that that's not quite enough.
Yeah. So we got a question coming in from the chat. You guys have said in the past that Fed rate needs to match the inflation rate before inflation is under control, historically speaking.
Jay Powell actually got that question himself.
Yeah. And I think that's what needs to be done. I mean, kind of my read on yesterday is they are going to make a stepwise change and probably put the end on the 3 rate hike cycle. But that we're probably at this point going to get into a new cycle of 50 basis point rate hikes until we reach what I would argue is probably somewhere closer to 6 to 6.5%, which would put us right there at the core PCE level. They said, if you look at futures right now, the terminal rate is going to hit 5.18 somewhere in like May of next year, potentially June. I think that I would take the over on that all day, every day. I think that they're probably what we're going to have is they're going to say, we're going to do 50 basis point rate hikes. Then the chatter's going to come in. Well, maybe they're going to pause again. And then at some point we'll probably kick down to single 25 basis point hikes until we start clicking up closer to 6.5%. That's how I think it's actually gonna go versus how they're saying it's gonna go.
Yeah, so there are a couple inflation rates, and Jay Powell actually was asked this question. He was asked, what is the underlying inflation rate that you guys think is going on right now? And he said, I don't really know. There's a lot of estimates out there, which, I mean, I get it. I get it. There's a lot of ways to calculate inflation, but if you were the principal body to determine 2% inflation, you should at least be able to tell me what 2% inflation is.
Yeah, choose your
and how you're
benchmark.
measuring that.
Yeah.
I was like, if you tell me you're measuring with a meter stick or a ruler, but at least I know whether you're measuring with a meter stick or a ruler, because to that question, Jay Powell was actually asked that specific question. Do interest rates have to get above inflation? He said pretty much unequivocally, yes, they do. The question is, what inflation rate are they using? If they use core CPI, that's 6.6% right now. If they use core PCE, that's 5.1%. And we don't know what the path is going to be. So presumably the way the Federal Reserve is thinking about this is that over time, you'll see inflation gradually go down and the interest rates gradually go up. And at some point, you're going to have that interest rate above the inflation rate. What happens if inflation keeps going up?
Yeah.
And I think we're going to get more data on this next Thursday when the CPI report comes out. And that's something that's going to be watched extremely closely.
Yeah, the follow-up question, does it need to exceed the inflation rate? I think to your point, Ben, they are hoping that they're going to accidentally exceed it on a convergence. Their thought is like, we're going to keep raising rates. It's not going to continue to peak. It's going to start coming down. At some point, they can converge. And at that point, they can maybe hold above that for a certain period of time and then cut to try and basically equate the two and keep it wherever it is. But my guess would be inflation is probably going to continue to go up, at least for the short term. And so they're going to have to continue to raise rates, and they're probably going to either get behind the 8 ball again or end up raising rates much, much higher than they're anticipating now. They seem to think it's somewhere a little over 5%. I would say it's 6% plus. Maybe it could get to 7%. I wouldn't be surprised. I just don't think the narrative they're laying out right now that they're going to, slow the degree to which they raise and then eventually kind of figure it out somewhere in the middle of next year, I think is unlikely. I think they probably continue to raise all the way straight through next year, even if it's just single hikes at a time.
At the end of the day, they still think it's transitory. I don't care what they say.
Yeah.
They will not say that it's transitory anymore, but they believe it's transitory. And the reason you can tell that is because they do think that it's going to come back down. That is the consensus. Inflation will normalize. We're not in a wage price spiral. Jay Powell said we're not in a wage price spiral, which befuddles me a little bit when wages for people who remain at their jobs just hit a cycle high of 7.8%. But who am I to tell him what I think is going on? But I do think, you had one last thing. You had an apartment company, Next Point Residential, saying we're able to raise our rental rates double digits because our lessees are making that money. Like they're able to pay it.
And they're unable to buy a house.
That's the definition of a wage price spiral.
Yeah.
So I don't think Powell is listening to some of these people. That's my concern. How did the market respond? The 10-year sold off. Once all the dust settled, it sold off pretty significantly. Now 4.18% on the 10-year. The stock market fell off about 2.5%. The euro weakened relative to the dollar. Dollar strengthened pretty much against every other currency. And on the interest rate hikes, there really actually wasn't that much change in expectations apart from shifting the end of the hiking cycle out from May to June, which is kind of small, and then also increasing the expected number of hikes next year from about 2.5 to 3. But other than that, most of the damage was done on the 10-year, in the dollar, and on the S&P 500.
Yeah, it's been a rough 24 hours. I think we're going to continue to see rate hikes. I think that we're going to, at some point, it's going to be pretty blunted, the reaction. I think at a certain point, the more they raise, the less it's going to impact the market. And I think once we kind of hit that, we'll be on the other side of this. But again, today another rate hike, another big down day in the market. tech wreck. This is the cycle we're in, and we've been talking about it for weeks that we're anticipating no real pivot. Jay Powell came out very strong against the pivot, and we saw all that get sucked right back out of the market.
All right, big jobs report tomorrow. We will be here at 8:30. Hope to see you there. Have a great day.